Good evening. You're very welcome this evening to our webinar, Anti-Money Laundering, the Irish Landscape, presented by Conor Duff. My name is Pat O'Donnell and I will be facilitating tonight's session. I'm a director of the Leading Edge group, of which Regenstein is a part of, and it's great to see such a strong attendance tonight on the subject of AML. I hope no matter what your background or interest in AML, you'll find it very helpful. Before we get started, just some housekeeping. Please reduce the number of apps and pages open on your device to ensure the best possible streaming quality. You'll be able to ask questions throughout the presentation and we'll pose them to Conor. You can just add them to the comments section. And we will also have a Q&A session at the end of the presentation for any questions left over. If we don't answer your questions during the presentation, we will follow up after the webinar, or you can email us with any questions or queries that you may have. So before I hand over to Conor, a brief introduction to who Regenstein are and the services we offer. Regenstein is a network-based consultancy company who offer clients a high caliber pool of independent consultants. Regenstein only use industry experts, not generalists, and we offer a faster, more responsive service to our clients than traditional consulting models. We specialize in areas such as HR, cybersecurity, GDPR, and tonight's subject, advanced money or anti-money laundering. Why Regenstein? Our experience shows that clients want more control and value for money from their consulting engagements. Our client-first focus, working in partnership with businesses, means we listen and deliver advice specific and tailored to your needs. Businesses want to work with people they trust, and Regenstein model delivers tailored consulting designs in partnership with the client and industry experts. And this brings us to one of our experts who's going to take tonight's session. I will now hand over to Conor Duff for his presentation on anti-money laundering, the Irish landscape. Thank you, Conor.
Thank you, Pat, and thank you very much to Ciara Murphy, Pat, Dylan and Shifra for their kind invitation to speak to you all this evening on a very live issue at the moment, and that is anti-money laundering. My name is Conor Duff, and I'm one of the consultants with Regenstein. I'm also a practicing barrister, and I also lecture on the City College's Diploma in Anti-Money Laundering. This evening, I'm going to be covering a range of topics with you to see the latest developments on AML, and we're going to be looking specifically at the legislative landscape here in Ireland. So as you can see on the slides, I'm going to go through the legislative landscape, what the current lay of the land is with the legislation. We're then going to move on to deal with designated persons. Some of you may be wondering, what is a designated person? In our experience, a lot of organizations mistakenly think that a designated person is an individual within an organization who is responsible for AML. However, that's incorrect. A designated person, as we will see, are categories of organization or company who are susceptible or amenable to the AML legislation. So we're going to see at that, look at that provision as we go through the slides. We're then going to look at the definition of AML as set out under the Criminal Justice Act of 2010. We'll have a brief look at the money laundering process itself. And then we will be moving on to more core issues that I really want to look at, and that are the obligations in respect of risk assessments, due diligence, beneficial ownership, all arising under the AML requirements. We'll have a brief look at how Ireland has been performing in respect of its AML obligations in particular sectors. We'll then look at competent authorities for supervision. As you're all aware, it's not just criminal offences for individuals who commit a money laundering offence, but there are also various competent authorities who are designated for supervising particular industries. So we'll see, for example, the central bank are one such competent authority for financial institutions and credit institutions. So we'll be looking at that. We'll then have a little look at central bank enforcement and see whether the central bank have been using a carrot or a stick in respect of their enforcement powers. And then finally, I want to look at the impact of the up and coming 6th anti-money laundering directive, which is due to be transposed into Irish law very shortly. So we'll have a little look at what's coming down the line for AML. So as I mentioned, you're all very welcome tonight. It's great to see the numbers of people who are interested in this event. So please do feel free to write any comments you may have in the chat box facility on StreamYard, and we will do our best to address those questions either throughout the presentation or at the very end of it. So the first port of call is the current legislative landscape, and I know there's quite a lot to take from the slide that's currently before you. And the long and the short of it is that the legislative landscape here in Ireland is an absolute mess. So we have various European instruments such as directives and regulations. As a lot of you are familiar, under Article 288 of the TFEU, the two principal ways in which Europe can make laws is through the use of directives or regulations. So from a European perspective, we have 6 anti-money laundering directives currently, and we have 2 regulations. Both of the regulations are in respect of beneficial ownership requirements. In respect of the directives themselves, the 4th anti-money laundering directive was probably the most substantive of the directives to date. That's really where we get our obligations in respect of training, due diligence, risk assessment, and so on and so forth. Then the 5th anti-money laundering directive largely deals with crypto and cyber currencies and really sought to bridge the gap that was identified arising from the 4th directive. It also deals with other minor matters such as PEPs and certain due diligence matters. And then recently, the 6th anti-money laundering directive was enacted, and I will be spending some time dealing with that as we go through. Prior to 2010, money laundering offences were largely criminalised in a welter of criminal legislation. And as you know, under the 2010 Act, not only does it deal with money laundering offences itself, but it also deals with terrorist financing offences. And prior to the 2010 Act, we had the Criminal Justice Terrorist Offences Act 2005, which was really the principal piece of legislation for terrorist financing offences. Then in 2010, we had the long anticipated Criminal Justice Money Laundering and Terrorist Financing Act of 2010. And that really had as its objective the idea to consolidate the pre-existing laws in respect of money laundering and bring it into one unified piece of legislation with terrorist financing. Now, as matters currently stand in Ireland, the 2010 Act is the principal piece of legislation. So it's the most important piece of legislation that we currently have here in Ireland. The 2011 Criminal Justice Act largely deals with sanctions and penalties for non-compliance with money laundering offences. Then in 2018, after a long delay, Ireland introduced the Criminal Justice Money Laundering and Terrorist Financing Amendment Act of 2018. And I'm sure some of you are familiar with the newspaper reports at the time that Ireland faced over €2 million fine from the European Commission for failing to transpose the 4th anti-money laundering directives on time or at all. So the 2018 Amendment Act amends the 2010 Act, and that had the effect of introducing the 4th AML directive into Irish law. Don't worry, we're moving on from the legislation now at the moment. It's just important that we're aware of really the lay of the land with money laundering. Then very recently, only a couple of months ago, we had the Criminal Justice Money Laundering and Terrorist Financing Amendment Act of 2021. Now, that had the effect of transposing the 5th anti-money laundering directive that I'm sure a lot of you are familiar with. It was advertised all over the news recently with the enactment of the 2021 Act. And then we have 2 regulations from Europe, that both relating to beneficial ownership. The first was in 2019, which related to corporate entities. The most recent one was in 2021 in respect of trusts. Usually when I teach anti-money laundering, I always say that 2014 was really the hot and sexy time for Protected Disclosures Act, and really the hot topic then was whistleblowing. And then recently enough, in 2016 and 18, I suppose, with the GDPR and the Data Protection Act of 2018, data protection was the hot and sexy topic. So I keep pushing the point that I think now is the time for AML to take front and center stage and to be the hot and sexy topic of our time. So certainly the beneficial ownership regulations of corporate entities had a large role to play in respect of AML knowledge. And those regulations is where we get the requirement to file our beneficial ownership register with the registrar of companies. And a failure to do so can result in quite significant fines. So I think when the regulations came into force and set out the obligation on corporate entities to file their beneficial ownership register, that really largely only then did organizations really say to themselves, right, we better get our act together now with AML requirements. So they have impacted greatly on awareness of AML issues. As I mentioned at the very get-go, designated persons relate to entities or institutions that are susceptible or amenable to AML obligations. When I think it was the third directive or the first couple of European directives, that AML obligations largely only arose in respect of credit and financial institutions. However, since then, that list has been dramatically added to, and we see now that the list of designated persons is set out under Section 25 of the 2010 Act as amended. So really, if you come under this definition, you are required to comply with the AML obligations set out under the 2010 Act and the EU regulations. So the AML rules apply to credit institutions, financial institutions, auditors, external accountants or tax advisors, relevant independent legal professionals, including solicitors and barristers, TCSPs or trust and company service providers, property service providers, casinos, private members club in respect of their gambling activities, high value goods dealers. So originally it was the case that you were a high value goods dealer if you dealt in goods to the value of 15,000 or more. However, that has been brought down in virtue of the fourth anti-money laundering directive to 10,000 euros. So it largely affects jewelers, precious stone and metals and so on, and car dealerships, etc. And then the minister has the ability to make regulations in extending the list of designated persons. Turning to the definition of money laundering or anti-money laundering, it's defined, and this is set out under Section 7 of the 2010 Act. Money laundering is defined as doing any of the following in circumstances where the person knows or believes or is reckless as to whether the property is the proceeds of criminal conduct. So the first is concealing or disguising the true nature, source, location, disposition, movement or ownership of the property or any rights relating to the property. Secondly, converting, transferring, handling, acquiring, possessing or using the property. Or thirdly, removing the property from or bringing the property into the state. That's all set out under the Criminal Justice Act. So as you can gather from that definition, there needs to be an original criminal offence that has been committed in order for the money to become dirty, for want of a better word. So effectively, the money needs to be derived from the commission of a criminal offence. And that is what we refer to as a predicate offence. So the predicate offence is the original criminal offence that was committed that really gave rise to the dirty money. So an example of a predicate offence could be possession of drugs with the intent to supply. It could be prostitution. It could be effectively any criminal offence that is set out under statute. So there are 3 stages to the money laundering process. Obviously, I probably put as the 0 stage is the predicate offence, because obviously the money needs to derive from the commission of a criminal offence. But the first stage of the money laundering process is the placement stage. Now, the placement stage relates to the division of the illegal funds into various entities, including bank accounts, companies, offshore accounts, etc. The second stage of the process is then the layering stage. Now, the layering stage, it's colored green for a reason, and that's the stage that our due diligence measures really kick in to detect and prevent money laundering from occurring. And then the final stage of the money laundering process is the integration stage. Now, at integration, that is where the money has now been assimilated with all of the other legitimate financial system and has largely been integrated into such a legitimate system. So I just want to set out then some of the obligations that are on us as designated persons, what we need to do, what the Act tells us we need to do. And this applies to every designated person. So the first important obligation arising under the 2010 Act is the obligation to conduct a risk assessment. Now, in Regan Stein's experience, there is quite a significant confusion surrounding the risk assessment. Largely, Regan Stein have found that organizations or designated persons have largely only been conducting a client risk assessment. And this is a pet peeve of the central bank that we will be returning to later on as well. The central bank have highlighted time and time again that largely there are 2 types of risk assessment a designated person must conduct. The first is a business risk assessment, and the second then is a client risk assessment. So dealing firstly with the business risk assessment, this risk assessment takes a holistic view of your organization to see what are your susceptibility to money laundering, what are your controls in place that you currently have, what services or products do you offer that tend to be riskier in nature or more prone to attracting money laundering, and taking your clients as a whole or as a collective, and what level of risk does that pose to your organization as an entity. Turning to the second type of risk assessment, which is a client risk assessment, that will largely take account of your individual customer, your individual client, or the individual transaction that your client or customer is seeking to undertake. So that is a real common area of confusion that Regan Stein have found in respect of their independent risk assessments that they carry out. Risk assessment, in my view, is probably the most important thing an organization can do to combat money laundering. It's no good having a really robust or really good customer due diligence measures in place without a really robust risk assessment having been conducted. And as I usually mention in training, is that your risk assessment informs your customer due diligence measures. So it's only after you conduct a really robust risk assessment will you know what type of customer due diligence measures your organization or company should apply. So risk assessment for me is the most important stage of your compliance. Now, surprisingly, there are a number of relevant provisions in respect of risk assessment, all of which carry a criminal offence. As you can see there on the slide, we don't want to worry too many, but you can see there they're quite hefty. There can be a term of imprisonment. There's a Class A fine. So the first obligation is Section 30A of the 2010 Act as amended, which requires a designated person to document their risk assessment and to document and identify and assess the risks of money laundering and terrorist financing in respect of the business. Then Section 30B is the client risk assessment, so the assessment of risk in relation to a customer or transaction. And then Section 54 deals with your internal policies, procedures, and training. So there is a statutory obligation for your organization, if you're a designated person, to have an AML policy in place within your organization, to have procedures in place as to how to deal with, for example, a suspicious transaction report. And there is also a mandatory statutory obligation for your organization to receive training in respect of money laundering offences. And rather uniquely, the training is requirement under the Act requires you to have an understanding of your legal obligations in respect of anti-money laundering. Pat, I might turn to you at this juncture before we move on to customer due diligence to see if we have any questions in the chat facility.
Yes, Conor, we've got a very interesting question actually in from Rosemary. She was asking how should a charitable body address this particular issue, especially in relation to philanthropic donations?
Yeah, so that's an important issue, and the national risk assessment that was conducted in 2016 in Ireland identified that non-governmental organizations or charities really are from medium to low level of risk for money laundering offences. So how do they address their AML obligations? Well, largely their first question they need to ask themselves is whether they are a designated person under the 2010 Act, and if they are, what activities do they conduct that is amenable to the legislation? And thereafter, the usual requirements will apply. So your risk assessment, your customer due diligence, your beneficial ownership register. So largely all of the provisions apply, and it's a matter for you then to implement those within your organization. But it is a very good question, and it is difficult. Regulation, particularly regulation that is quite costly for an organization, particularly with transitionary costs and associated costs, does place a huge obligation on charities and other organizations similar to Rosemary's. So yeah, it is a pertinent issue. So I think that's all the questions for the moment, Pat, is it?
That's all so far, yeah.
Brilliant, thank you. Okay, so if we then go on to customer due diligence measures. So as I mentioned, your risk assessment will inform your customer due diligence measures that your organization may decide to impose. So the first obligation is set out under sections 33 and 33A and 24A of the 2010 Act as amended, and it requires identification and verification of your customers and beneficial owners. 36A is an examination of the background and purpose of certain transactions. And then section 37 deals with the requirements for enhanced customer due diligence. So for example, PEPs, who are politically exposed persons, and other such entities. And just looking a little bit closer at your customer due diligence measures, another area of confusion that Regenstein commonly encounter is that some designated persons believe that they themselves can decide what layer of customer due diligence measures to apply. So we have standard customer due diligence, we have simplified customer due diligence, and enhanced customer due diligence. So some organizations believe that they have the gift to decide which layer of customer due diligence to apply, but largely it's governed by the legislation. The legislation will set out precisely what level or layer of customer due diligence should you apply. So if we look, for example, at enhanced customer due diligence, there is a mandatory obligation to apply enhanced customer due diligence when you're dealing with PEPs, politically exposed persons. Also, when you're dealing with countries that pose a high level of risk in respect of money laundering offences. Now, the European institutions have been clear to say that that relates to doing business with third countries. What is a third country? Any country outside of the European Union. So from a theoretical perspective, there is a mandatory obligation to conduct enhanced customer due diligence now on Britain and the UK in virtue of Brexit, because they're no longer a member of the European Union. They no longer have to adhere to the directives, obviously, from Europe. So there is now a mandatory obligation, certainly from a theoretical perspective, to apply enhanced customer due diligence measures to companies or designated persons within the UK. But I should say that largely the UK have been keeping up to speed with their obligations. They have already transposed the 4th and 5th directive. So it'll be interesting to see how they deal with the 6th anti-money laundering directive, whether they may decide themselves to enact further legislation. We'll just have to wait and see. Other customer due diligence measures then, so 38A, there is your enhanced customer due diligence measures for high-risk third countries. 39 is enhanced customer due diligence in cases of heightened risk. Section 42 and 49, requirement to report suspicious transaction reports and the offence of tipping off. The offence of tipping off is informing the client or the customer that you have a suspicion in respect of them committing a money laundering offence, etc. And then Section 55 is the obligation to keep records by designated persons. And again, this is another area that Regenstein has experienced a number of organizations lack in. So every time you undertake training, every time you undertake an evaluation of your risk assessment, revise your customer due diligence measures, all of those should be documented. And at Regenstein, they try and promote a practice of document your thoughts. So when you're originally conducting your risk assessment or you're choosing which layer of customer due diligence to apply, you should document your thoughts as to why you chose a particular layer of customer due diligence, why you perhaps categorized a particular customer as low risk or high risk, etc.
Connor, we just have a question in here, and I think you've addressed it through that last comment there. It's from Vincent. It's in face-to-face situations we may have an opportunity to notice something untoward, but with online detection may be more difficult, and in those cases will reporting suspicion protect us from prosecution? I guess it goes back to your last point as regards following your train of thought or following your thought process when processing a transaction. Would that be correct?
Yeah, largely correct. Absolutely. And, I think you brought up a huge issue, and that is at the moment in times of COVID and everything being conducted online, it can sometimes be difficult to verify, precisely who you're dealing with, particularly when you're dealing with documents, etc. But it largely remains, as Vincent alludes to in his question, a judgment call. If you have a particular suspicion and you have a ground for that suspicion, it's important then to document that suspicion within your suspicious transaction report. And if you're within an organization with employees, employees should simply fill out the form, and then the MLRO, your money laundering reporting officer, will review it and consider whether it constitutes making a suspicious transaction report on Garda Síochána and the revenue commissioners. But it is a good question, and it does highlight a lot of the difficulties now with an online world and so on. And this question also applies, I suppose, to beneficial ownership regulations. In a lot of the training that we've provided, we find that sometimes, particularly with investment companies, it's very difficult to ascertain who you're dealing with, who the beneficial owners are, etc., etc. But we see in the beneficial ownership regulations that they kind of give a catch-all allowance for those types of situations, where you list namely the directors of the company and the CEO. But certainly you have raised a very pertinent issue, Vincent. Yeah. Turning then to consider how we are doing in Ireland. So we have the benefit of 2020 compliance rates that was published by the Department of Justice in their annual report in 2020. And they undertook a review or inspections of trust and company service providers, high-value goods dealers, 1 private member club, and 11 external accountants and tax advisors. And you saw there that largely the compliance rates were pretty good. So the largest was in the private members club, which is just 1 with 100% compliance. High-value goods dealers, 52% compliance. Trust and company service providers, 60% compliance. and thereafter the majority of them were partially compliant, which still doesn't cut the muster, I suppose, for the legislation, but it is largely some good news. You know, sometimes when we're talking about money laundering and we're going through the definitions, sometimes feels that it's very, you know, it's somewhat intangible, or it's kind of not very prevalent in Ireland as it would be in other jurisdictions. But if we look here at the statistics, I'm sure some of you will be quite surprised. So if we go back in time to 2005, we see that there were 10,735 suspicious transaction reports that were made to An Garda Síochána and the revenue commissioners. If we fast forward to 2017 or 2019, we see that it's 24,521, over 100% increase. You know, so you know, what has led to this increase? Is it the case that there is more money laundering offences being committed? While I think that may be somewhat of the case, I seem to form the view that largely I think there's greater awareness of AML obligations and there's greater detection focus on money laundering offences. And that has led to the dramatic increase of reports that are being made. But it is certainly interesting to see the you know, the quantitative data there on the slide. And then in respect of the criminal prosecutions, in 2016, there were 18 persons charged with 22 money laundering offences. Fast forward to 2018, and we had 73 persons charged with 284 offences. I know some people usually ask, how come there's more offences than there are persons? And the answer is that one person can be charged with multiple offences. So that is one of the reasons. So then we're moving to competent authorities for supervision. So it's not just a, you know, whether you will face a criminal prosecution under the 2010 Act, but certain competent authorities have been designated responsibility for supervision of certain categories of designated persons. And this is all set out under Section 60 of the 2010 Act as amended. So if we look at the central bank, they are the competent authority for supervising regulated credit and financial institutions, including some trust and company service providers, which are subsidiaries of regulated entities. So credit and financial institutions also applies to credit unions. It also applies to banks, investment companies, etc., etc. And the central bank have been quite generous with their guidance that they have provided in respect of the credit union sector, particularly. I myself am a director of one of the largest credit unions in Dublin, and we certainly have benefited from very clear guidelines from the central bank in the credit union sector. The Law Society of Ireland are the competent authority for solicitors. The Bar Council and the Legal Services Regulatory Authority are the competent authority for barristers. There are 8 prescribed accounting bodies for accountants. For property service providers, then, is the PSRA, or the Property Services Regulatory Authority. And then if you're not within any of the above, you fall into being supervised by the Minister for Justice as the competent authority. So it's more of a catch-all provision there for anybody who's feeling left out. So I wanted to spend a few moments, rather quickly actually, just to kind of go through what have the fines been like for organizations, how have the central bank been enforcing obligations on regulated entities. So we have the benefit of a number of case studies that is published by the central bank on their website that I just want to spend a couple of minutes going through. But these slides should be made available to you afterwards if you want a more in-depth analysis. So at Regenstein, we have looked at the case studies and the decisions from the central bank and researched the central bank guidelines in detail. And we have found that largely the factors that govern or that are employed by the central bank, and this is on their online literature, so what will they consider as part of their investigation? will be the seriousness of the conduct. So the seriousness of the AML offence, or the AML offence, the extended period of time in respect of the breaches. So we'll see some of that as we look at the case studies. Cooperation during the investigation stage. So that's very important. And that's one of the crisis management tools that you have should you be subject to an investigation. And then the actions that your company or organization take to remediate the breaches that were identified by the central bank. So if we just look at a couple of case studies here, the first was Campbell O'Connor and Company investment firm. The central bank imposed a €280,000 fine for 5 breaches of the, that should be the 2010 Act, including a failure to conduct risk assessment. They didn't do a risk assessment of their customer base. There was no risk assessment in respect of terrorist financing, no adequate policies and procedures in respect of AML, failure to scrutinize and monitor customer transactions, failure to provide staff training on identifying suspicious transactions, failed to provide training from July 2010 to September 2015, failure to provide training on the identification of suspicious transaction reports, failure to ensure that all necessary arrangements were in place with third-party entities. So this is, representative of a large amount of the case studies. Certainly, we have experienced in Regenstein that organizations largely will use template structures or template guidelines that were provided to them that were very, standard form templates without taking account of the individual factors of the organization. We see if we go back to the credit union, for example, the central bank in their newsletter have identified that the credit unions have an over-reliance on a body called ILCU, which is the Irish League of Credit Unions, and found that they were using these template standard form documents without identifying bespoke characteristics of their organization and reflecting that in their policy documentation. So this is just a warning as to the level of in-depth analysis that the central bank will conduct.
So, Conor, just a quick question there. So, would that be some of the guidance that you're offering in terms of the templates that you use need to be designed for your particular business?
Absolutely, and both the central bank and the legislation deals with this. That it's not enough to download a template form from the internet and populate that as relevant to your organization. You really need to, particularly with the risk assessment, carve the risk assessment around the nature of your organization and to ensure that you're taking account of all of the individual characteristics of your organization. Like if we were to take the credit union for an example, some credit unions offer mortgages, others don't. Some credit unions have credit and debit card facilities, rather. Others don't. So you can't have a situation where the same documentation or the same templates are being used for the whole industry. It's just not the case, and it can't be done. And it doesn't just obviously apply to the credit union sector. It applies to other organizations as well. I remember I gave a training to an Irish agricultural business, and I was kind of thinking, why on God's earth have they sought this training? It was only then I realized, or through speaking with them, did I realize that they also had an investment company that was part of the business. So obviously your risk assessment and your due diligence measures will only need to relate to that side of your business that is susceptible to the money laundering obligations. Appian Asset Management Limited, from the 13th of June 2018, the central bank imposed a fine of 443,000 for, quote, significant breaches, including defective controls to protect client assets against fraud, inadequate policies and procedures to monitor transactions, detect and report money laundering, failure to provide appropriate training to staff, failure to ensure that employee performing a role might expose to risk. In Intesa San Paolo LifeDAC, It was imposed with a €1 million fine from the central bank, failure to conduct risk assessment on their business risk assessment, failure to have adequate policies and procedures in place for both customer due diligence and suspicious transaction reports. Ulster Bank, 3,325,000 for breaches for their risk assessment, so insufficient ML policies, procedures, processes, failure to conduct assessment of money laundering for over a period of 2 years. The risk assessment didn't take into account any quantitative and/or qualitative evaluation of their exposure. They identified particular weakness with their pre-1995 customers. There was no customer due diligence review at all of such customers, and the policy did not match practice. There was a failure to provide training to their non-executive directors, failure to provide training to directors on identifying suspicious transactions, etc. AIB, similarly, 2,275,000, failure to report suspicious transactions, failure to conduct customer due diligence. So largely, a lot of the same things are applying. Bank of Ireland, 3,150,000, failure to conduct risk assessment, failure to report STRs, suspicious transaction reports, etc. Failure to provide training, policies and procedures. Western Union Payment Services, again, 1,750,000, failure to have procedures, failure to monitor transactions. Bray Credit Union, so that was €98,000 fine, failure to adopt adequate policies and procedures, no training or records kept, failure to conduct adequate customer due diligence, monitor or scrutinize transactions, policies and procedures. Community Credit Union, 21,000 for breaches, no policies or procedures, failure to conduct risk assessment, customer due diligence. The list just goes on. We're near the end, thankfully. AXA MPS Financial Limited, 50,000, failure to conduct customer due diligence, their risk assessment. But importantly, look at this. It says the firm responded by providing assurance that it was fully committed to having high standards. They cooperated with the investigation and they communicated that it had remedied the breaches expeditiously. And then UBS International Life System, this is the last one, 65,000, and a failure to demonstrate that it instructed any of its staff on the law relating to money laundering, failed to adopt adequate written policies. However, the firm responded by cooperating fully with the examination and the investigation. They stated that they took the matter extremely seriously and were fully committed to ensuring that they were brought into compliance, and they also rectified the breaches in question. So I just want to turn to yourself, Pat, before we talk about the 6th anti-money laundering directive, if that's okay. If there's any questions.
Yeah, there's a couple of questions there, and it's an observation as well, Conor, in terms of it. If you find yourself in that situation where you are being investigated and it's crisis management, I guess from the case studies you've shown, is the steps you take even at that stage can really have a bearing on the fine that's imposed on the company.
Yeah, so absolutely. And again, that's another service provided by Regenstein, is crisis management in respect of these situations. And largely, as we see from the central bank case studies, it's how you go about addressing those problems expeditiously can have a huge impact on the severity of the sanction imposed by the central bank. So you saw there in the two last case studies that if there was a willingness to cooperate fully with the investigation, a commitment to coming into compliance, and that they have remediated the issues, well, then certainly the central bank do take that into account in their assessment of the sanction to be imposed in the particular circumstances of the case. So certainly we see that organizations who do comply and do address the issues expeditiously, the sanction is greatly reduced. But like all things, Pat, it's more important to have a proactive approach in respect of money laundering so that these issues never arise in the first instance.
That's great. And I think, Eamon, that goes some way to answering the question that you had in the comments as well.
Okay, thanks, Pat. So I just want to spend some time looking at the 6th anti-money laundering directive that's coming down the tracks. And this is really an interesting directive, and it will seek to kind of consolidate the laws in respect of anti-money laundering and to really address the issue that I identified in one of the early slides in respect of the legislative landscape and it being so messy. So the sixth anti-money laundering directive, the impetus for it is set out there by Valdis, I won't even try and pronounce that surname, who is the Executive Vice President for an economy that works for people in the EU, and our own Commissioner, Mairead McGuinness, who is the Commissioner responsible for financial services, financial stability and the Capital Markets Union. She said that money laundering poses a clear and present threat to citizens, democratic institutions and the financial system. The scale of the problem cannot be underestimated, and the loopholes that criminals can exploit need to be closed. Today's package significantly ramps up our efforts to stop dirty money being washed through our financial system. We are increasing coordination and cooperation between authorities and member states and creating a new EU AML authority. These measures will help us protect the integrity of the financial system and the single market. So there are a number of key changes that are being introduced in virtue of the sixth directive. And the first is the proposed EU AML authority, which will establish a single integrated system of AML and the control of financing of terrorism supervision across the EU based on common supervisory methods and a convergence of high supervisory standards. They will also have the power to supervise some of the, quote, riskiest financial institutions that operate in a number of member states and require immediate action to address imminent risks. It will also monitor and coordinate national supervisors, such as our FIUs and some of the other supervisors that we looked at under Section 60 of the Act. And it will also support cooperation among national FIUs, which are a division of An Garda Síochána, the Financial Intelligence Unit, and facilitate coordination between the different FIUs within the member states. So it's trying to create somewhat of an integrated system for addressing money laundering. This one is particularly interesting. It seeks to introduce a single EU rulebook, and that largely will address the kind of legislative difficulties that we've been having to date, and will seek to harmonise the AML rules across the EU for more detailed rules and kind of bring it all together or harmonise the legislation. Existing national registers of bank accounts will need to be connected as well in order to provide more expeditious access for members of the Financial Intelligence Unit to inspect. And it will also provide access to law enforcement authorities to faster financial system, speeding up the investigations and the recovery of criminal assets. It will also extend the applicability of the AML rules that were really achieved in virtue of the fifth anti-money laundering directive, but it will address the entire crypto sector, the sixth directive, and it will also remove or get rid of anonymous crypto asset wallets, which will be prohibited in virtue of the sixth anti-money laundering directive, because as we see from the European literature, crypto and cyber currencies have presented a threat or a difficulty for AML regulation. There'll also be a limit placed on large cash payments of €10,000, and the rationale or the reasoning behind this was set out by the Commission as making it harder for criminals to launder dirty money with this 10,000 cash limit. And this area is quite a concern to us, particularly those criminologists or criminal lawyers who may be on the call. There are some significant areas of concern set out under the directive. Particularly we see in recital 12, in order for criminal law measures to be effective against money laundering, a conviction should be possible without it being necessary to establish precisely which criminal activity generated the property, or for there to be a prior or simultaneous conviction for that criminal activity while taking into account all relevant circumstances and evidence. So that's the recital. But if we look carefully at Article 3.3a of the directive, it says a prior or simultaneous conviction for the criminal activity from which the property was derived is not a prerequisite for a conviction for the offences referred to. So the current position is that if you want to prosecute an individual for committing a money laundering offence in our criminal courts, you first need to obtain a criminal conviction for that predicate or that original offence that gave rise to the dirty money. So you need to have the first conviction before you can prosecute for the money laundering offence. Now the sixth directive, interestingly, will obviate the requirement for prosecutors to get that first conviction, and it will allow a prosecutor to go straight to bringing a money laundering charge against an individual without having first secured that original criminal conviction of the original criminal offence. And I just wanted to quote, probably quite cheeky of me, but I just wanted to quote, Mr. Justice Hardiman in Professor Claire Hamilton's text on the presumption of innocence. He said, "Lest we one day find with surprise that our law has altered in an undesired way while our attention was elsewhere. The price of liberty is eternal vigilance." So, there is a question that remains and will need to be teased out as to whether this provision, I'm sorry, I see Stephen Megan has identified section 11, but this directive will enhance that provision or provide it far more clearly, certainly in virtue of Article 3.3a of the directive. But certainly interesting questions arise as to the presumption of innocence of that original criminal offence if you can move directly to the money laundering charge. But it's just more so food for thought, I suppose, at this stage. So turning then just to look at Regan Stein's experience with anti-money laundering, and then we'll move on to what they provide. So largely Regan Stein are big players in the area of AML. A lot of their experience emphasizes, again, as I mentioned, that there is a common confusion between risk assessment and business risk assessment. Sorry, I'm just hearing some feedback there. I don't know whether it's gone now. That risk assessments fail to take account of all risk, and it's really important for an independent set of eyes. Largely, there was a failure to provide appropriate training to personnel, difficulties with policies and procedures, customer due diligence measures being applied that are largely inappropriate to the category of business. So again, using those standard form templates, policies and procedures, and largely knowledge of the area can somewhat be mixed, particularly in the private sector. So what can Regan Stein provide? So Regan Stein provide largely training and consulting services. They can provide bespoke training to all layers of an organizational structure. They provide tailored policies and procedures to take account of the nature of your organization. They can conduct an independent risk assessment, or they can stress test your independent risk review or review it. They will also review your customer due diligence measures and implementation. They will also provide you with ongoing updates in respect of the legal landscape on AML. They do provide crisis management. If you aren't looking for a kind of training session, you can also undertake the AML workshops that are relevant to your business. So you saw already in the case studies that maybe employees or members of staff aren't appreciating the level of risk within the organization or don't know how to deal specifically with suspicious transaction reports. So that's largely what those workshops are designed for, and also for non-executive directors. And then they'll also review your beneficial ownership compliance. So I'll hand you over to Pat, but before I do, I would like to again thank Ciara Murphy, Pat, Dylan and Shifra for the kind invitation, and for all of you for attending the webinar. But I'll hand you over to Pat, and I'll be happy to answer any questions any of you may have in respect of this. So thank you all very much.
And thank you, Connor. That was very, very informative. And thank you for speaking this evening. We really appreciate that. If you have any, we've got a few minutes left. So if you've got any questions, you can pop them into the comment section and we'll pose them to Connor. Connor, we do have a few questions that came in by email before the event. So I'll just bring up some of them now. And you touched on one previous to this in terms of the interaction between AML and corporate governance. Can you maybe speak a little bit about that?
Yes, so this is actually a particular area of interest for me because corporate governance has a huge interaction with anti-money laundering requirements. So largely, you know,
it's Connor, you're on. We've lost you there.
Oh, sorry. Am I back again? Can you hear me? Can you hear me now? Can you hear me now, Pat? I don't know whether you can hear me?
Okay, good.
Okay. Oh, sorry. A couple of people are saying they can hear fine. Okay. So corporate governance is really, really important. It's important that organizations are creating a culture of compliance, that they are largely understanding their AML obligations, that really the compliance is coming from the very top of the organization right through to the bottom of the organization, that everybody understands that they have a role to play in respect of anti-money laundering. And largely that kind of culture really emanates from your board or your whatever, the senior management. So it is, corporate governance is hugely important. And also the legislation sets out that you also have to ensure that all layers of the organization are receiving the appropriate training and understand their legal obligations in respect of money laundering. I don't know whether, Pat, you're still there, are you?
Thanks, Connor. Maybe we'll just get in one more question. And we've got another question here that just popped in. In terms of the training, what's the biggest issue that you see with training in the various organizations that you deal with?
Yeah, so well, the biggest issue would be that there's no training. So that's largely the biggest issue that arises. Really, the training can be standard, so it can go through your obligations arising under the legislation. But really, as we saw with those case studies, that there is much more sophisticated and bespoke level of training that's required, particularly with organizations that they're receiving appropriate training within, you know, relevant to the role that they're performing within the organization. So that would largely be it. Yeah. Thanks
again. And one more then, Connor, we have just our final question. If you're concerned about your AML process now, where's the best place to start? Or is that how long is a piece of string?
Yeah, so if you are concerned about your level of compliance, your first step is to understand what is necessary within the legislation. So what must you do? So as we've already identified, you must conduct a risk assessment. You must conduct your customer due diligence measures. You must have policies and procedures in place. You must conduct training. So the very first, that's the order how I would deal with them. So the first is an appreciation of what you need to do. The second would be a robust risk assessment. And then, as I mentioned previously, your customer due diligence measures will really inform, your risk assessment will inform your customer due diligence measures that your organization may decide to adopt. So I think in that order is how I would do it. But yeah, it's certainly, you know, there are some guidelines. So I know, for example, the Law Society of Ireland have published very comprehensive guidelines, and they're really excellent to solicitors. Similarly, the central bank have been quite proactive as well in providing information to their entities as to how they can go about compliance. So look to your supervisor as well to see what they have to say, or what are the particular weaknesses within the sector.
That's great, Connor. Thank you very much. So we're nearly at time. I'd like to thank Conor for taking the time to speak to us this evening. I'd like to thank all the attendees. Thank you very much for attending. I hope you found it very useful. And as Conor has already reiterated, I'd like to thank everyone behind the scenes, Ciara, Dylan, and Shifra, for making this happen today. So if you have any, if you need to speak to us at any stage, our contact details are on the screen. You can phone us or email us, or you get us through the normal social channels. Thank you very much. Have a good evening.
Thank you.